It's 8:30. I only have one student online. I will go on with the class. Others will join the class. Let me just put a note through. The class has started. All right. Awele, let's go on with the class. Tonight we are looking at capital structure and theories of gearing. Under this topic, we shall be discussing what is capital structure, why is capital structure important decision, we shall be discussing risk, what is risk, types of risk, the business risk, the financial risk, how to calculate business risk, how to calculate financial risk, how to calculate total risk. We shall discuss what is gearing, how do we calculate gearing. Then we shall round up our discussion with what are the theories of capital structure? What are the theories of gearing? All right. Okay, the number has increased. We are hoping more students will join the class. All right, let's move to the topic proper. We are discussing tonight capital structure and theories of gearing. If you pick a company's financial statements, if you are given a company financial statement and you looked at the statement of financial position of a company, the statement of financial position is divided into 3 segments. The statement of financial position is divided into 3 sections. You have the assets segment. Under the asset segment, we have the non-current assets and current assets. That is the first segment or first section of a balance sheet. The second section is the liability side, the liability. Under this section, you have the non-current liabilities and the current liabilities. Then the third section is the capital side, the capital and reserves. That is the capital structure. that we want to discuss today. The capital structure shows how a company is being financed. A company capital structure shows who has contributed money to support the finance of a business. Therefore, if you want to define capital structure can be defined as the combination of different types of finance used by a company so as to meet its business objective. I'll take that again. Capital structure can be defined as the combination of different types of finance used by the company so as to meet its business objective. This capital structure will include the ordinary share capital, reserves, long-term borrowing in the form of debentures, and preference shares. This capital structure will include 1, the ordinary share capital, 2, equity reserves, 3, long-term borrowing in the form of debentures. 4, you can also have preference shares in the capital structure. So if you have to define capital structure shows the different combination of finance a company utilizes so as to meet its business objective. We have explained what is capital structure. Number 2 discussion. Why is capital structure decision important? Our number 2 discussion is why is capital structure decision important to companies? Why should company pay attention to its capital structure? It is argued that a company capital structure will have impact on its cost of capital, and we have impact on its market value. Capital structure decision is important because this decision will affect the company's cost of capital. And this decision will affect the company's market value. So it is important for finance manager to pay attention to its company's capital structure, because the capital structure will affect your cost of capital. If your cost of capital is increasing, that means you are running your business at an higher cost, and that can reduce your value. So a finance manager must pay attention to capital structure decision making, meaning that the company must pay attention to the different types of finance it uses in its capital structure. All right. We have defined what is capital structure. We have explained why capital structure decision is important to us. As finance managers, we must look at our company capital structure. Our capital structure explains how our company is being financed. Generally, a good finance strategy, a good finance strategy is to finance long-term projects with long-term capital and finance short-term projects with short-term finance. In other words, as finance managers, we must use long-term finance, long-term capital to finance long-term projects. And we must use short-term capital to finance short-term projects. A company can be financed by equity or debt, or a combination of equity and debt. A company can be financed by equity or debt, or a combination of equity and debt. Where a company is financed by equity, such company is referred to as ungeared company. Please, you observe that I'm trying to slow down at some points. I want us to grab those points. Where a business is financed by equity only, then that company is regarded as ungeared company. Ungeared. Where a company is financed by a combination of equity and debt, such company is referred to as geared company. So please note, a company may either be geared or ungeared. Okay. It is very rare to see a company being financed by debt only. It is not practicable that a company will be financed by 100% debt. Equity finance or equity capital is the money contributed to the business by the owners of the business. In other words, any money coming to the business from the owners of the business will be categorized or classified as equity financing. Debt finance refers to all forms of borrowing to the business. All right. Our next discussion. What is risk? What are the types of risk? Risk can be defined as the variability in returns. Risk can be defined as variability in business return. You can define your risk as volatility in business return. You can classify risk into two. Risk can be classified into two. We have the business risk. This is the variability of the firm's operating income. This is the variability of the firm's operating income. This variability is associated with the industrial sector in which the firm operates. This variability is associated with the industrial sector in which the firm operates and the competitive advantage possessed by the firm. In summary, business risk is the risk that has to do with the nature of your business. Variability in your return due to the nature of your business, due to the nature of your business sector. For example, we have the banking sector. There's a risk business risk. Construction sector. We have risk, the business risk of the construction company is quite different from the business risk of the banking sector. You have the oil sector. You have some risk peculiar to the oil sector. We have the telecommunication sector. When you are talking of business risk, this is the risk that has to do with the nature of your business. Variability in your return due to the nature of your business. Please note, where a company is financed by equity only, where a company is financed by equity only, such company will be exposed to business risk only. Such company will be exposed to business risk only. In other words, ungeared company will only be exposed to business risk. Ungeared company will only be exposed to business risk. Number 2, financial risk. This is the additional variability in returns to shareholders. This is the additional variability in returns to shareholders that arises because there's debt finance in the company capital structure. Financial risk arises because there's debt capital in a company capital structure. Financial risk is associated purely with debt finance. Financial risk is associated with debt finance. The financial risk is zero in a company that is financed by equity only. The financial risk will be zero where a company is financed by equity only. Please note, where a company is geared, that is, where a company is financed by equity and debt, where a company is financed by equity and debt, such company will be exposed to both the business risk and the financial risk. Such company will be exposed to both the business risk and the financial risk. Please note that. All right. We have explained what is risk, the type of risk. Our next discussion is gearing. Or leverage. Gearing can be defined as the extent to which a company is financed by debt capital. Gearing can be defined as the extent to which a firm is financed by debt capital. Gearing is the proportion of debt capital in the company's capital structure. You can define your gearing as the percentage of debt capital in a company capital structure. You can also define your gearing as the ratio of debt capital to equity capital. The ratio or the percentage of debt capital to equity capital. You can calculate your gearing. Gearing can be calculated either using market value approach or book value approach. Gearing percentage can be calculated either using the market value approach or the book value approach. Please note, unless the examiner states otherwise, gearing should be calculated using the market value approach. Unless the examiner states otherwise, always calculate your gearing using market value approach. That is, your gearing is the market value of debt divided by the market value of equity. The debt we are referring to is the long-term debt. The debt we are referring to is your long-term debt. All right. Oh, excuse me, please. See, okay, any question, please? Any questions so far? Any questions so far? For those just joining the class, we have discussed what is capital structure. Why is capital structure important? Why is capital structure decision important? We discuss geared and ungeared firm. We discuss risk, type of risk, the business risk and the financial risk. We have discussed what is gearing, also known as leverage, how to calculate our gearing using market value approach, or you can also use book value approach. When we say book value, that is the balance sheet value. The value as stated in the company's balance sheets. Our next discussion is theories of capital structure. Theories of capital structure. There are several theories of capital structure. However, two main theories attempted to explain the effect of changes in gearing on the company's work and value of company. I'll take that again. There are several theories of capital structure. However, we have two main theories that attempted to explain the impact of capital structure on the company's weighted average cost of capital and on the company's market value. Two main theories of capital structure attempted to explain the impact of changes in gearing. When we say gearing, changes in capital structure on the weighted average cost of capital and on the share value. These theories are: one, the traditional theory of capital structure, otherwise known as the net income approach. And the second one is Modigliani and Miller theory, otherwise known as net operating income approach. We shall be explaining these two theories now. One, traditional view of capital structure. This school of thought argues that there's an optimal level of capital structure. This school of thought argues that there's an optimal level of gearing for a company. And this is the level of gearing at which the weighted average cost of capital is minimized. What this theory is saying is that companies should take advantage of debt finance. Introduce debt into your capital structure. Try to borrow money to finance your business. Once you approach to borrow money, that means you are introducing debt into your capital structure. It also means that you are introducing gearing into your capital structure. So this theory is saying that companies should take advantage of debt finance by borrowing money to finance their business. Companies should continue to borrow money. Why? Because debt finance is cheaper. The cost of debt is cheaper than the cost of equity. Hence, companies should continue to borrow money. If you are borrowing money, that means you are bringing in more debt finance to your business. By bringing in more debt finance to your business, the weighted average cost of capital will continue to fall. The WACC will fall. As the cost of capital is falling, then your value, the value of the company will continue to increase. But it will get to a point where your WACC will be at the minimum point. It will get to a point, as you are bringing in more debt, then you are going to get to a point where the WACC will be as minimum. Once you achieve that minimum point where your WACC, where the weighted average cost of capital is at minimum, then the company has achieved an optimal level of gearing. At that point, the company should stop adding debt finance to the business. If you attempt to bring in more debt, then your work will spark up. Once you have achieved an optimal level of gearing, at that point, your work will be as minimum and value of the company will be as maximum. Then the company should stop adding debt finance into its capital structure. This is the position of the traditional theory of capital structure. The traditional view of gearing concluded that there's an optimal level of gearing where work is minimized and the value of the company is maximized. That is the summary of the traditional school. That is the summary of the traditional school. Any question, please? All right, the second school of thought, Modigliani and Miller theory, in brackets, no corporate taxation without taxation. Modigliani and Miller theory, without corporate taxation. Let's go to this. Modigliani and Miller challenged precisely in 1961. Precisely in 1961, Modigliani and Miller, MMM, challenged the position of the traditional theory of capital structure and argues that there is no optimal level of capital structure. MMM argues that there is no level of optimum capital structure. No optimal level of capital structure. In other words, MMM is saying that a company can decide to finance its business with equity, or you can decide to finance your business with debt, or finance your business with a combination of equity and debt. This will not affect your cost of capital. And once your cost of capital is not affected, then your value of the company will not be affected. Please try to understand this concept. You can put it in your own word. Modigliani and Miller in 1961 challenged the position of the traditional theory of capital structure and argues that there is no optimum level of gearing. In other words, there is no optimum level of capital structure. A company can decide to finance its business with equity or finance its business with debt or finance its business with a combination of equity and debt. This will not affect the company's market value. This will not affect the company's cost of capital. Their argument is based on certain assumptions. One of the major assumptions is that it assumes that there is no taxation in the economy. Company is not liable to pay tax. That if there is no taxation, if we ignore corporate tax, then the value of a geared company will be the same with the value of an ungeared company, where there is no corporate taxation. Value of an ungeared company is the same as the value of a geared company. All right, let's continue. The work of an ungeared company will be the same as the work of a geared company. If you like, borrow more money. As a company is borrowing money, that means you are bringing in cheaper source of financing. The cost of debt is cheaper. But the cost of equity will continue to increase. The weighted average cost of capital remain unchanged. As cost of equity is falling, as cost of debt is falling, cost of equity is increasing, WACC remain unchanged. Once WACC remain unchanged, total value of the company will remain unchanged, regardless of the level of gearing. This is the position of Modigliani and Miller. If there is no taxation, provided there is no tax. Therefore, M&M come to the conclusion that, in a simple word, the level of gearing is irrelevant for the market value of a company. M&M therefore comes to the conclusion that, or reach the conclusion that, in a simple word, when we say simple word, a word without taxation, the level of gearing is irrelevant for the value of a company. There is no optimal level of gearing that a company should try to achieve. Modigliani and Miller arguments, ignoring taxation, can be summarized as two propositions. We can summarize the argument of Modigliani and Miller, where there is no taxation, as two propositions. One is, look at it, the first one, the weighted average cost of capital of a geared company is the same as the WACC of an ungeared company. That is the proposition one, provided there is no taxation. If the WACC is the same, the total value of an ungeared company will be the same as the total value of a geared company. Look at it, please. Value of geared is the same as the value of ungeared. That is proposition one. based on Modigliani and Miller, provided there is no taxation. Proposition 2. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. This is given in the formula below. Cost of equity of a geared company, KEG, is equal to cost of equity of an ungeared company plus value of debt divided by value of equity, bracket cost of equity of an ungeared minus cost of debt, close the bracket. If you are to explain this, the cost of equity in a geared firm is equal to cost of equity of an ungeared firm plus financial risk premium. This aspect is called financial risk premium. The cost of equity of an ungeared plus the financial risk premium will equal to cost of equity of geared company. I'm aware that you are still on cost of capital computation. Juwan is taking you guys cost of capital computation. The knowledge you are going to get here we further improve your knowledge of cost of capital computation. All right, let's move on. Where we only define the variables here. This is WACC of ungeared, weighted average cost of capital of a geared firm. WACC of ungeared, weighted average cost of capital of an ungeared firm. Value of geared firm, total value of geared, that is VG. VU, total value of ungeared. VG, total value of geared. Your VE, market value of equity. Your VD, market value of debt. KEU, cost of equity of ungeared. KEG, cost of equity of geared. KD, cost of debt. All right. Our next discussion, Modigliani and Miller theory, allowing for corporate taxation with corporate taxation. In 1963, M&M revised their model to include corporate taxation. In 1963, M&M revised their model to include corporate taxes. The inclusion of corporate taxation significantly changes their analysis. The inclusion of corporate taxation significantly changes their analysis. With corporate tax, MMM argued that value of geared firm will be higher than the value of an ungeared firm. With corporate tax, MMM argued that value of a geared firm will be higher than the value of an ungeared firm. Hence, companies should utilize more of debt finance so as to take advantage of cheaper cost of debt. By taking debt finance, the company will enjoy tax relief on interest payable. This tax relief will reduce the cost of debt. Reduction in cost of debt will reduce the company's WACC. Reduction in company's WACC will enhance the market value of the company. Hence, MMM is saying that where there is corporate taxation, the company should take advantage of debt finance and utilize more of debt finance. This will reduce the weighted average cost of capital. Reduction in WACC will increase the market value of the company. MMM concluded that there is an optimal level, and that optimal level will be at a point where the company take advantage of debt finance up to the highest practicable level. The company should take advantage of debt finance up to the highest practicable level. As you are bringing in debt finance is cheaper. The cost of debt is cheaper, but the cost of equity will continue to rise. The effect of cheaper debt finance is higher than the rise in cost of equity. Hence, WACC will continue to fall. Look at the conclusion here. Modigliani and Miller therefore reached the conclusion that because of tax relief on interest, there's an optimal level of gearing that a company should try to achieve. A company should be trying to make its optimum gearing as high as possible to the maximum practicable level in order to maximize its value. Again, Modigliani and Miller arguments allowing for corporate taxation can be summarized as two propositions. The Modigliani and Miller arguments allowing for corporate taxation can be summarized as two propositions. Where there is corporate taxation, WACC falls continuously as the level of gearing increases. Look at the first proposition. The WACC of an ungeared company is lower than the WACC of a geared company. Look at it, please. The work of an ungeared company is equal to the work of an ungeared company into brackets 1 minus dt, debt multiplied by tax divided by debt plus equity. So if you are given the work of an ungeared company, you can derive the work of a geared company. Remember, what is geared company? A geared company, a company financed by equity and debt. An ungeared company, a company that is financed by equity only. Please note this. The work of a geared company is equal to the work of an ungeared company, brackets, open bracket, 1 minus dt divided by 1 divided by value of debt plus value of equity. The total value of a geared company is equal to the total value of an ungeared company plus the value of the tax sheet, tax advantage. In other words, this DT is called tax sheet. By taking debt finance, I'm going to enjoy tax relief. So geared company, we have a greater value compared to ungeared company. This is represented here. Value of geared is equal to value of ungeared plus dt. Then the last one, second proposition. The cost of equity in an ungeared company is higher than the cost of equity, the cost of equity in a geared company is higher than the cost of equity in an ungeared company. The cost of equity in a geared company is equal to the cost of equity in an ungeared company plus the financial risk premium. This is represented in formula below. Cost of equity of geared is equal to cost of equity of ungeared plus bracket 1 minus tax, close my bracket, open another bracket, cost of equity of ungeared minus cost of debt, close the bracket, multiply by value of debt over value of equity. You may be required to use any of this formula in your exam. Examiner may not state this expressly, but the question might take you to using any of this formula in your exam. All right, any question, please? These are the two main theories of capital structure that are frequently being tested. These theories involve calculations We have other theories, but other theories, you have the static trade-off theories. These are readables. That there's a trade-off between benefit of debt finance and the cost of higher indebtedness. We have the pecking order theory. We have pecking order theory. There's an order of financing. This is talking about preference and an order of preference or pecking order when you want to finance your business. And we also have the market timing theory. But like I said, the two main theories are the traditional theory of capital structure and the Modigliani and Miller theory. Modigliani and Miller can be discussed where there is corporate taxation and where there is no corporate taxation. Any question, please? All right, if there's no question, because we need to manage the time well, we shall be looking at question number 1 in our study pack. This question is available in page 202 of our study pack. If you have your study pack with you, you can go to page 202, Tesla PSC. We shall be discussing this question with the explanation we have gotten so far. All right, let's go on with this question, please. Tesla PSC has a geared capital structure with details as follows. Value of debt, 200 million. Value of equity, 300 million. Total value of the company, 500 million. Existing cost of debt before tax, 12.5%. Existing cost of equity, 20%. Tax rate, 40%. Next, the company proposes to raise 25 million of new equity and to use the finance raised to repay 25 million of outstanding debt. This is million. Outstanding debt liabilities. All earnings are distributed as either interest or dividends. Please note that point. All profit, that is earnings, all the company's profits are either distributed as interest or dividends. This implies that There's no retained profit. Once we get our profit, we pay the debt holder their interest. The balance is distributed to shareholders as dividends. Required. Calculate the existing WACC. Calculate existing weighted capital, existing earnings before interest and tax, and calculate return required by the ordinary shareholders to compensate them, to compensate for business risk only. That is the A part of the question. Let us start with the A part. Now, in my usual manner, I just don't rush to start solving questions. Please, to what extent do we understand the examiner requirements and the examiner question? Is there any part of this question that you require clarification? Yes, we can speak. And let us feel free to speak. Assuming you are to calculate WACC, weighted average cost of capital, how do you compute the WACC, the existing WACC now, based on the existing capital structure? All right, I'm assuming that the question is clear. It is not impossible that, it is very possible that you have some formula for calculating your WACC. It is not impossible that you have been given formula for calculating your WACC. I always try to explain to students, if you are given the formula and you want to memorize the formula, while memorizing the formula, understand the formula you are memorizing. Because for WACC, you can have different formula that will give you the same results. They will all give you the same results. Different formulas. So it is important to understand the formula and its usage and its meaning. What is weighted average cost of capital? That is the average cost of the different types of capital the company has used, with weights proportional to the market value of each capital. All right, the first one, A, Roman figure 1, that now says calculate existing weighted average cost of capital. To do this, our WACC can be calculated with cost of equity multiplied by the value of equity plus under bracket cost of debt after tax multiplied by value of debt, close your brackets. Everything divided by value of equity plus value of debt. Now let's go and pick these variables. Look at the question. Cost of equity, KE, is 20% as given in the question. Cost of debt given to us before tax is 12.5%. You now need to compute cost of debt after tax. To do this, you just simply say bracket 1 minus the tax. The tax rate is 40%. Look at the question, please. Please calculate cost of debt after tax.
Seven 7.5%.
7.5%. That is the cost of debt after tax. Now look at the question. What is the equity value you are given in the question? $300 million. Value of debt we are given in the question, 200 million. The WACC is equal to my cost of equity, 20%, multiplied by the value of equity, 300,000, close your bracket, plus our cost of debt after tax, 7.5%, multiplied by the value of debt, 200 million, divided by 300, 200. Please work this out. What is your WACC? The existing WACC of this company. What is the existing WACC of this company? Please work this out and confirm the answer. You should have 15%. Yes, please. Let's confirm this.
It's confirmed.
So the answer is 15%. Again, you can try to use to give yourself comfort. You can try to use the formula that Joanna has given you to work this out. All right. A Roman figure 2. We have to calculate earnings before interest and tax. A2. Calculate earnings before interest and tax. Now, examiner wants us to calculate the profit before interest and tax. If you look at the question, there is no information about profit and loss account at all. Now, explain to yourself, what is profit before interest and tax? What is earnings before interest and tax? Earnings before interest and tax. This is the earnings meant for debt holders, shareholders, and governments. The earnings before interest and tax. This money will be shared between debt holders, government will collect tax, and shareholder will collect dividend. There are two ways you can derive this. There are two ways you can derive this. You can use your work to derive this. Your work can also be calculated. I've given one formula before. Work can be calculated as our work is equal to earnings before interest and tax into bracket 1 minus tax divided by value of equity plus value of debt. You can also calculate your work with this formula. That's why I was trying to say, I quite understand that at times you want to memorize some formula and you want to stick to that formula. But there are times where that formula may not be able to help you in some particular instances, because you are not even given the variables you are known with. Now, if you now understand the concept of work is return to providers of capital after we have paid tax. The meaning of work is return to providers of capital after we have paid tax. Now I can say, okay, this earnings before interest and tax. This is the earnings meant for shareholders, debt holders, and government tax. So I can now remove tax. That's why we said earnings before interest and tax, net of tax, remove the tax. That means if I remove the tax, I'm now left with earnings before interest, earnings meant for shareholders and debt holders. And what means returns to providers of capital. Who are the providers of capital? The debt holders and the shareholders. I can use this formula to derive my earnings before interest and tax. Look at it, please. I can do like this. I've computed WACC to be 15%. I will just come here. The WACC is 15%. Is equal to earnings before interest and tax. I don't know. Bracket 1 minus the tax, 0.4. Divided by value of equity, 300,000, plus value of debt, 200,000. Okay. I can move to page 2. I can continue from here. That's okay. 15% is 0.15 is equal to earnings before interest and tax, bracket 1 minus 0.4. This is 0.6 divided by 500. I can cross multiply. I can cross multiply this. Cross multiply. This will give me 0.15 multiplied by 500 is equal to earnings before interest and tax, bracket 0.6. 15% of 500,000. What do you have, please? This 75. Will give me 75 is equal to earnings before interest and tax, bracket 0.6. I can make earnings before interest and tax, make it the subject, is equal to 75 divided by 0.6. What is your earnings before interest and tax?
$125.
Therefore, my earnings before interest and tax is equal to 120 million. This is one approach. This is one approach. You can take also, if you want to prove this now out, you can do a work back. Get your dividends, get your interest. You can do a work back. Look at the work back. I'm only showing this as a second approach. Once you understand the first one, you don't need to start second approach. I can do like this, or I will just do statements. I have earnings before interest and tax. Then I need to less interest. Have we? Less interest. Is that not, please? What is the interest on our debt? compute your interest. Our interest is 12.5% of the debt. Is that not? Our debt is, okay, let me take away. %12.5% of debt, 200 million. Please compute the interest. Please compute the interest on this debt.
$25.
25. The interest is 25. I don't know this yet. I can denote this with X. Is that not? Earnings before interest and tax X. I don't know it. I want to derive it. I will less my tax, Abby. That means if I less my tax, I'm going to have earnings before tax. This should give me X minus 25. Is that not, please? Then I will now compute my interest. Sorry, I will compute my tax. My tax is 40%. 40% of this. 40% of this. If I do 40, that is 40% of X minus this. Let me do it this way. (0.4) bracket X minus 2 this. That is less tax. That will now give me profit after tax. Profit after tax. And the question says all earnings are distributed as either interest or dividend. That means my profit after tax is my dividend. What is the cost of equity? The cost of equity is 20%. Compute 20% of 300,000. That will give you the dividends. 20% of 300,000. That will give you 60 million. I can get my X now. I can get my X. If you open this bracket, 0.4 multiplied by X, but this is what I'm trying to say, X minus 25 minus 0.4 multiplied by X. That will give me 0.4X. 0.4 multiplied by 25. What do you have? (0.4 multiplied by 25. This will give me minus 10 million. That means my EBIT minus my tax must give me the profit after tax. And the profit after tax is the dividend. This is 60 million. What is X? Open this bracket, have X minus 25 minus 0.4x is equal to plus 10. Continue this working. X, collect like terms. X minus 0.4x. This will give me 0.6x minus 25 plus 10. This will give me minus 15 is equal to 60. Again, 0.6x is equal to 60 plus 15. Zero 0.6x is equal to 75. What is x? X is equal to 75 divided by 0.6. Our x is equal to 125. I also use this approach. But if you are finding it difficult, because this is more of mathematics now, we just did a work back. I started for my earnings before interest and tax. I represent this with letter X. Less the interest. Interest is 12.5% of the debt, 25 million. That means if I minus X from 25, I'm going to have earnings before tax, 20x minus 25. Then compute your tax, 40% of earnings before tax, 40% of 25 minus X. That becomes 0.4 into bracket S minus 25. If you open this bracket, you are going to get 0.4x minus 10. Now, to get your profit after tax, earnings before interest and tax less tax. That will give me my profit after tax. And the question says, all profits are distributed as dividends. That means my profit after tax is the same as my dividend. And your dividend is your cost of equity, return to equity holder. Your dividend is your cost of equity. In this question, the examiner says cost of equity is 20%. So if I want to compute my dividend, 20% of the equity value. All right. Like I said, you can stick to the first one. To derive your earnings before interest and tax. Or you can consider the second alternative. Any question, please? Now look at requirements A3. The examiner says calculate the return required by the shareholders to compensate for business risk only. How do we go about this? Before I answer this question, let me explain briefly when we say cost of capital. There are two ways to define cost of capital. There are two ways to define your cost of capital. You can define cost of capital from the company's perspective. You can define cost of capital from the company's perspective. Or you can define cost of capital from the perspective of the investor. If I want to define cost of capital from the perspective of the company, then cost of capital will be defined as the expenses incurred to obtain and utilize capital. If I'm to define cost of capital from the perspective of the company, then I'm going to define my cost of capital as the expenses incurred to obtain and utilize capital. For example, if I'm taking equity, then the company will pay cost of equity. That is dividends. By the time company is paying you dividends, you are going to receive dividends, but to the company is payment. If you look at debt, the interest on debt is the cost of debt. That is the expenses the company incurred in order to obtain debt finance. To the company, that expense is a cost. It's an expense. So if you are defining cost of capital from the perspective of the company, that is the expenses incurred in order to obtain and utilize capital. The second perspective, the cost of capital from the perspective of the investor. From the investor's perspective, cost of capital is return on investment. If I invest in company shares and the company is paying me dividends, that dividend to me is a return. But to the company paying it is a cost. If bank should give a loan to a company, bank will receive interest. That interest to the bank is an income, it's a return for giving loan. All right, so please note, what is cost to the company is return to the investors. So, A Roman figure 3. The question says, calculate return required by the ordinary shareholders to compensate for business risk. That means I need to ungear this company. This 20% existing cost of equity, this is the return to equity holder if the company is geared, because this company is geared. Because this company is a gears company, then we are paying shareholder return of 20%. And I want to know what will be the return to the shareholders for business risk only. That means if this company is not financed by debt, if this company is financed by equity only, what is the return to the shareholders? You now go back to that M&M formula now. In this question, there is taxation. So I'm going to look at M&M, where there is corporate taxation. I can come here and say, A Roma figure 3. A113. Return for business risk only. Look at the solution here. Using M and M with taxation. Look at the formula. The cost of equity of a geared is equal to cost of equity of an ungeared plus bracket 1 minus tax bracket cost of equity of an ungeared minus cost of debt, close the bracket. Value of debt over value of equity. When this company is geared, the cost of equity of a geared company is 20%. And I want to know the cost of equity of an ungeared. An ungeared company will only be exposed to business risk. I don't know this. This is what we are trying to calculate, X. The tax rate is 40%. The cost of debt, let me take it here. Cost of debt is 12.5%. Value of debt, I'm trying to manage this place here, is 200,000. Value of equity is 300,000. I can calculate S now. I'll just come back to the formula. 20% is equal to X unknown plus bracket 1 minus the tax rate 0.4 bracket X unknown minus 12.5 You can remove the percentage. Just save yourself the stress. Bracket value of debt, 200, divided by value of equity, 300. Work this out. What is X? Please work this out. What is our X? We can deal with it. We can deal with this with ease. I'll just do 200,000, 200 divided by 300. I have my figure. Multiply by 0.6. I can do like this. This is equal to plus bracket X minus 12.5 bracket 0.4. If you take 0.6 multiplied by 200 divided by 300, that will give you 0.4. Open your brackets. 20 is equal to X plus 0.4 multiplied by S. That will give me 0.4X minus 0.4 multiplied by 12, 12.5. This will give me minus this will give me minus 5. Collect like terms. 20 plus 5 is equal to 1.4x. What is x? This is 25 is equal to 1.4x. X is equal to 25 divided by 1.4x. What is our x, please? $17.86. That is the cost of equity of an engaged. And that is the return for business risk only. Our cost of equity of engaged is 17.86%. That is the return. Return for business risk or compensation for business risk only. Business risk only is equal to 17.86%. You observe that the cost of equity of engaged has reduced. When the company is geared, the cost of equity is 20%. When the company is ungeared, the cost of equity becomes 17.86%. That is the expected solution. That is the expected solution. Any question, please? Any question, please? Is the class trying to look at the what? Hey. Oh my God. We are done with the A part of the question. Now the B part. Look at the B part. After the change in capital structure, calculate the company's total market value, the shareholders' wealth, the company's WACC, and the company's cost of equity. Let's go back to the question small. The company proposes to raise 25 million of new equity and to use the finance raise to repay 25 million of outstanding debt. That means the capital structure has changed. The company is bringing in more equity and reducing the debt. That means the company's capital structure, based on this proposal, will change. Equity will increase, debt will reduce. Please, ladies and gentlemen, if you're in an exam, whether the examiner is texting any question, and you observe that the capital structure has changed, you observe that there's going to be a change in the company's capital structure. Before you can proceed with any other calculation, you need to first ungear the company. Once there is a change in the finance structure, once there is a change in the financial structure of a company, that means the existing WACC is no longer valid. The existing value is no longer valid. In that case, the first thing we are going to do is to ungear the company. When you say ungeared, it simply means remove the debt finance from the company. Remove the existing debt finance from the company. All right, let's go to this calculation now. Once there is change in capital structure, we need to ungear the company. Look at it, please. B, after change in capital structure. So B1 says calculate total value of company. You just come here. First, my first working to do is to do my first working ungeared the existing company. Look at it, how to do it using M and M, using M and M with taxation. Because there is taxation in this question, you are going to use M and M with taxation. Look at it. Value of geared is equal to value of ungeared plus DC. Value of geared, if this company is geared, the total value is 500. The existing company is a geared company. The total value is 500 million. Value of ungeared, we don't know. That's what we are trying to calculate. Plus, the company's debt is currently 200. And the tax rate is 0.4. Can come here and say 500. Value of ungeared, I don't know, plus 200 multiplied by 0.4. This will give you 80. That means value of ungeared is 500 minus 80. This will give me 420 million. If this company is ungeared, its value is 420 million. If this company is ungeared, that means we have removed the existing debt. This company will worth 400 million if there's no debt. Now, your second working will be to re-geared using the new debt. Your second working, that is the calculation now. 2. Regeared using the new debt value. Now, what is the new debt value? The new debt value will be our existing debt, 200 million. We are going to repay the debt by 25 million. That means new debt value is equal to existing debt 200 minus the repayment 25. Our new debt will worth 175 million. I can now go and regauge. We are still using M&M. Value of geared is equal to value of ungeared plus DT. The value of geared is equal to value of ungeared. If the company is not geared, 420 plus the new debt is now 75 into bracket tax rates. Please work this out. 40% of 75, 175. What do you have, please? Please.
70.
40. What do you call it, sir? Is that correct? Yeah. This becomes 490. That means the total value of new company is 490 now. You are done. Total value of the company after changing capital structure is equal to 490 million. What can you take from this? The total value of the company has fallen. By bringing in more equity and reducing what? Debt. Because debt is cheaper. Equity is more expensive. So what it means is that you are bringing in an expensive type of finance to the business. You are reducing cheaper debt finance. The value of the company has fallen. This is what the traditional school is saying, that if you bring in, it's better to take in more debt up to a point where your work will be at minimum. So you are done with B Roma figure 1. B Roma figure 2 is calculate total weight of shareholders. B2 says calculate total shareholders. Total shareholders weight. What the examiner is trying to ask you is that after changing capital structure, what is the value of the equity? To do this, We have gotten total value of the company in our B1. Total value of company is value of equity plus value of debt. And we know the value of debt. Then I can derive value of equity. That's why I always try to tell students, understand the question and requirement. Total value of company is simply value of equity plus value of debt. Now, we know the value of debt to be, we know total value of company to be 490. Value of debt, new debt to be 175. What is value of equity? Just come in. Look at it, please. Total value of company is 490 million. Value of new debt is 175 million. Therefore, I'll just minus this. Therefore, value of equity is 315 million. That is the total worth of the shareholders. Total worth of shareholders equal 350 million. If you observe this, the weight of shareholder has reduced. Before, the shareholder had 300 million. They brought in 25 million more equity. By increasing your equity, by increasing equity in the market value of equity will fall. That is what this is explaining now. Any question, please?
Please, sir.
Somebody make a sound there.
Yes,
Any
sir. Please, sir. Yes, sir. Since the question did not specifically state that we should use M and M, how do we know that M and N application is relevant here, sir?
You know, I've been disturbed that nobody is asking questions. It's either they know it all, or they are just like, whoa, this thing, let it just be. Since the question didn't say we should use M and M, how do we know that we are supposed to use M and M? Like I said, the examiner will not tell you whether to use M and M with task or without task. But you are going to now look at the question. What is the concept of M and M? He said, if you like, finance your business with equity. Or if you like, finance your business with debt. Or a combination of equity and debt. Provided there is no taxation, then the value of the company will not change. The work of the company will not change. That was the first model of M&M without taxation. Later, the model was revised to include corporate taxation. M&M now says, where there's corporate taxation, the value of a gears company will be greater than the value of an ungeared company. Meaning that if you bring in more debt, your value is likely to increase. And if you reduce your debt, your value is likely to fall. Now look at the question, sir. Look at the question. The company proposes to raise 25 million of new equity and to use this finance raised to repay 25 million of outstanding debt liability. Look at it. This is now taking us to change in capital structure. We are bringing in more equity and reducing debt. And this has taken us to M&M revised model, where there's corporate taxation, there's tax. M&M is now saying that if you are bringing in more equity or you are changing your capital structure, then your value will be affected if there is taxation. As soon as you observe that there is a change in company capital structure, before it was 200 million, 200 debt, 200 million of debt, 300 million of equity. Now you are bringing in more equity, reducing the debt. That means the capital structure has changed. And that is what M&M is saying, that if there's a change in your gearing and there's a taxation, value of the company will be affected. That was why we brought in that M&M here, that the gearing ratio has changed and there is taxation in this question. We can use M&M model with corporate taxation to answer the question. Is that better, sir? Hello, sir. Is that better?
Yes, it is.
All right. Thank you for asking that question, because I'm worried that nobody's asking question. No, I'm worried. Some will just say this capital structure, will they test it? Let it be, Joe. Now, after change in capital structure, calculate the company's WACC. Let's do this quickly and round up with the other one. Is Musa in class safe? Not sure he's in class today. A, that is, calculate the WACC now. You know the capital structure has changed. Definitely the WACC will change. The capital structure has changed. definitely the work will change. Calculate the work. You can use M and M again here, using M and M. Work of a gears company is equal to work of an ungears company into brackets 1 minus dt divided by d plus e. What is the work of ungeared? We have computed this before.
490. Oh, watt. Okay, watt. Sorry.
Look at it. The cost of
17.86.
company is the same as the work of an ungeared company. And this is equal to 17.86%. That is the compensation for risk only. That was calculated in A Roma figure 3. The cost of equity of an ungeared company is the same as the work of an ungeared company. That means there's no debt in that company capital structure. Our new debt for the new company, the debt is now, value of debt is now 175. Value of equity is now 315. We have all the variables. You can now get work of a gears company based on the new gearing ratio. Look at it. The work of this company now is equal to 17.86 bracket 1 minus our D, 175 multiplied by 0.4 divided by 175 plus 315. Close your bracket. The work of geared is equal to 17.86 brackets 1 minus 40% of 175. That should be 70 divided by 490. Please work this out. What is the work here? You should have 15.3%. Work it out, please.
$15.3 confirmed.
Yeah. So please, maybe after the class, create time to look at it. It's meant to assist your, this is just meant to aid. In fact, this one lecture is sufficient. It's meant to assist your cost of capital computation. In a normal day, I can just do one lecture and I'm done with it. Because the one we do a
if you are
lot
doing one
of
lecture, so if you are doing one lecture, if you can give assignment to be helpful so that we can now use that to practice, then send to you, then you can check and send back.
take one more class on this, don't worry. I can also give assignment, no problem. No problem. And the assignments, whether you ask or not, I always give. Although the last one, just like 2 students responded, albeit I will still, it won't stop from giving assignment also. Then the last one, that is B4 now. Calculate cost of equity. Remember, the capital structure has changed. So we need to recalculate the cost of equity. You can use for M&M using Modigliani and Miller. The cost of equity of a geared company is equal to cost of equity of an ungeared plus bracket 1 minus the tax. Close my bracket. Another bracket, cost of equity of ungeared minus cost of debt. Bracket value of debt divided by value of equity. You can take this. The cost of equity of geared is equal to cost of equity of your ungeared. We have calculated it before. 17.86 plus bracket 1 minus the tax 0.4 bracket 17.86 minus cost of debt 12.5. Value of debt now 175. Value of equity now 315. What is your cost of equity of the new company, the new geared company? Work this out now. If you have 19.6 or thereabouts, if you work this out, I have 175 divided by 315 multiplied by 0.6 multiplied by 17.86 minus 12.5. $17.86 minus 12.5. Multiply by 75 this divided by 350 multiply by 0.6. Or 17 points. Seventeen point eight. The answer here $19.61 there are something like this. Please reconfirm this.
19.65.
Yes, I know something here. You observe that by bringing in more equity now, the cost of equity has reduced. Before, we're paying them 20%. Now, by bringing in more equity and reducing debt, the cost of equity is now 19.65. All right, you can always look at this after the class to satisfy ourselves. Any question, please? Yeah. I think the cost of equity after changing capital structure. Cost of equity $19.6. May God give us a better understanding. We still take one more class on this topic. It's about, the topic is about changing capital structure, the impact on cost of equity, weighted average cost of capital, and value of the company. This topic, capital structure. Capital structure is trying to look at if there's a change in your capital structure, will this affect your cost of equity? Will this affect your work? Will this affect your value? Look at what we have computed now. Okay, look at what we have computed. Let's go back a bit. Before, the company has equity 300 million, debt 200 million. The company's cost of equity then was 20%. The company's work then was 15%. We computed in A1. Now, before changing capital structure, the company's work was 15%. The company's cost of equity was 20%. The company's total value was 500 million. Now, after changing capital structure, look at it. The company proposes to raise 25 million of new equity and to use the finance to repay 25 million of outstanding debt liabilities. That means there's change in capital structure. After changing capital structure, what is the total value of the company? After changing capital structure, total value of the company becomes 490 million. That means there's reduction in value. Before 500 million. Now, when there is a change in capital structure, value becomes 490 million. This implies that change in capital structure will have impact on the value of the company. Wealth of the shareholders. Before, the shareholders' wealth was 300 million. They brought in 25 million more. The shareholders' wealth should have been 325 million. But we calculated shareholders' wealth to be 315 million. That means shareholders have suffered reduction in wealth. By bringing in more equity, market value of equity will fall. The company's work. Before the change in capital structure, the company's work was 15%. Now, by changing the capital structure, the company's work increased to 15.3%. This means that change in capital structure has impact on the company's work. By bringing in more equity and reducing the debt, the company's work has increased. Lastly, the company's cost of equity. Before changing capital structure, based on the existing capital structure, the company's cost of equity was 20%. After changing capital structure, the company's cost of equity is now 19.6%. So the topic is about impact of changes in capital structure on the company's cost of equity, company's weighted average cost of capital, and company's market value. All right. May God give us a better understanding. We shall be stepping out of this classroom now. Let's have a blessed evening.